Hi guys, I thought we'd do something different today, and I just wanted to create a video on a topic in trading psychology, specifically the one thing that makes me lose the most trades, or historically that have made me wipe out my account entirely. When you just start out, you start with an account with real money, and you don't know what you're doing, but you're trying, and within a few weeks or days, depending on how risky you trade, you tend to see an empty account. Now, it doesn't matter what you started with, whether it's $5 or whatever. This tends to happen to just about everyone who starts off in Forex trading. Now, there are quite a lot of reasons for that, including risk management and other things. But the one thing that I found that's happening to me, or happened to me the most, was that when I had a bad trade, I would actually just leave it to run against me, keep going further and further into the red, and with no explanation from my side as to why I'm doing it. And it took me a few years to figure out exactly why this is happening. And the explanation lies in a psychological concept, or a field of study in financial behavioral psychology called the disposition effect. Now, the disposition effect, that is something that actually refers to the tendency we have to let our losses or bad trades run, and let our winners get cashed out early. So in essence, what you're doing is every loss is running and running and running until your account's wiped out, and your winners, you're actually taking profit very early. You see a huge move, you took maybe 10 pips out of a 1,000 point or 100 pip move. And the reason for that is also explained with the disposition effect and the psychology around it. So the first thing we have to look out for is, why do we do this? So what is this concept? Why do we do this? So if you look at this study by Sheffrin and Statman, this was way back in 1985. It's not a new concept. They actually discovered that people dislike losing significantly more than they enjoy winning. It's been described as one of the most robust facts about the trading of individual investors, because investors will hold stocks that have lost value, yet sell stocks that have gained value. So basically, you're holding onto losses and getting rid of winners. Why do we do that? So in 1979, Kahneman and Tversky traced the cause of the disposition effect to the so-called prospect theory. The prospect theory proposes that when an individual is presented with two equal choices, one having possible gains and the other having possible losses, the individual is more likely to opt for the former choice, even though both would yield the same economic result. So you would rather choose gains than choose losses. That makes more sense, even though it could have the same result. But if you look deeper into prospect theory, this has an adverse effect on our trading. So the study further in 1992 called The Advances in Prospect Theory, Cumulative Representation of Uncertainty, suggested that losses are twice as powerful psychologically as gains. So in layman's terms, we feel the pain of a loss twice as much as we feel the joy of a success. Now let's quickly look at the graph representing this. So if you had a 5 gain on this side, and the value you add to it in your mind is this y-axis, and the losses to the left side and gains to the right side. A $5 gain versus a $5 loss, you would actually assign twice as much value to that. So for a $10 loss, if you assign a value of 1, a hypothetical value of 1 to a $10 gain, you would assign a hypothetical value of -2 to that same amount. So you would feel the pain of that loss twice as much as you feel the joy of that amount of gain. So a $10 loss you'd cry about, but you won't get ecstatic about a $10 gain. Now, why is that? That's an interesting concept. So basically what happens is, when you have a successful trade, you just accept that what should have happened did happen. And if you have a losing trade, you have to face the fact that you either missed something or that you were entirely wrong altogether. This is referred to as loss aversion. Now, if you look at loss aversion, this was confirmed that humans are theorized to be hardwired to be loss averse due to the asymmetric evolutionary pressure on losses and gains. So if you were, let's go back to caveman theory when they were still hunting for food. If you're operating close to the edge of survival, the loss of a day's food could cause death, whereas the gain of an extra day's food would not cause an extra day of life. That is the key concept behind this. Obviously, unless the food could be easily and effectively stored. But if you think about that concept for a minute, if you don't have food today, you're starving. But if you have food today, you're not starving. Doesn't mean you're going to be exceptionally fit tomorrow. It just means that today you're not starving. So not having it is actually much worse than having it. So there's a reason for this. Psychologically, there's a reason for this. We understand this. We can wrap our heads around this concept. So this was first proposed as an explanation for the endowment effect, the fact that people place a higher value on a good that they own than on an identical good that they do not own. So also by Kahneman and Thaler this time in 1990. So if you think about that, you have the potential win, a potential good trade that could run for 100 pips, and it's already 10 pips into that run, but you're not sure it's going to go the whole 100 pips. So you take the 10 pips that you're sure of. This means that it's the endowment effect. You place a higher value on a bird in the hand is better than 2 in the bush. So you place a higher value on that 10 pips that you can guarantee versus the 100 pips that are hypothetical. So that's the reason and why we do this. It isn't difficult to understand why we do this. It's basic human nature. So there are a few ways to avoid this. The suggested method of avoiding the disposition effect, they say that the effect can be minimized by means of a mental approach called hedonic framing. So, for example, individuals can try to force themselves to think of a single large gain as a number of smaller gains, to think of a number of smaller losses as a single large loss, and to think of the combination of a major gain and a minor loss as a net minor gain, and in the case of a combined major loss and a minor gain, to think of the two separately. You're trying to manipulate your mind into thinking into a different way. This isn't always easy. So in a similar manner, investors show a reverse disposition effect when they are framed to think that their investment as progress towards a specific investment goal rather than a generic investment. So what we're doing is every single loss we are seeing individually as a negative effect to our entire portfolio. You're thinking of one loss as a potential forecast for what could happen to every trade. And the best way to get around it is to, think of it as your portfolio as a whole, and try and ignore the individual wins or losses. You should just look at your entire portfolio. Is it up? Is it down? Now, this has somewhat worked in the past for me. When I'm up, I can, when you're up, it's easier to take smaller hits on losses. Granted, you have tight stop losses and much larger take profit areas or prices, then those runs are easier to effect when you're already up with your portfolio. But what if you're down? What if you start the month off bad? Now you need to make up for this. This is where this suggested method of avoiding it becomes really difficult. If you're already down and you try to look at the big picture is negative, and then you're screwed. So what do? So what I found works for me is I call it opposite bias analysis. I'm sure there's a psychological term for it. In the economic behavioral psychology field, they must have a different term for this. I don't know what it is. This is just what I apply. So I'm sure there's a name for it, but I call it opposite bias analysis. So every time I have a trade that turns against my position, let's say I'm buying this, and suddenly there's a huge move to the downside, it just doesn't work for me. Now, usually I have a tight stop loss, but some assets that you trade, the stop level is already like 14 pips away, so that's already a huge loss. So what do? Now you are in that position where you want to see if it recovers. Will it go back to that price where you got in, and potentially go further to the upside? So that's the problem, is those huge stop levels that prevent you from putting really tight stop losses in can cause this effect. And now you have this effect where you're thinking, oh no, it needs to recover. I'm already down 140 points or 14 pips. It needs to recover to that before it can continue the trade it's supposed to do. So once this happens, that's when you apply opposite bias analysis. So if it turns against your position, goes that 14 pips or whatever, that's unexpected, attempt to analyze the current move to determine if you would take a trade in the opposite direction. Would you go in a reverse trade? So would you actually try to prove that the move against that position is justified? Go in with a strong bias against your own position and try to prove that the move should go in the direction it's going. So basically, you're trying to disprove your current position. Now, if you do get to disprove your current position, let's say you clear everything from your chart, completely blank slate, nothing else but price action. You start your analysis afresh, but now you convince yourself about the opposite bias. So you take the current position that you have the order in as buy. Now you say, how do we analyze this from a seller's perspective? Why are they pushing this down? So you do a full analysis from a seller's perspective. And if by the end of that analysis, you find that, oh wow, this price could actually push down even more, then close your trade. You've just proven to yourself you're in a bad trade, so close it out. Even if you have to take that 14 pip loss or whatever your stop level is that it moved against you, you are now convinced of the opposite direction, so close your trade. Don't open a trade immediately, you're emotional now. So close your own trade that you had open, and then take a breather, because you just had it wrong, and that sometimes happens. So you need to, basically reset and just try and approach this differently. Don't make an emotional decision immediately. Don't say, oh no, I just lost 14 pips. Now I need to make it up, so I need to go short because I just proved it would go short. Remember that when you did that analysis, it was with a seller's bias. You try to disprove your buy position to see if you should close it. And you have to do this on every trade that goes against you. You have to try and disprove your position. And if you do disprove your position and you've proven the opposite direction, go out, get out, close the trade. Take the hit. It happens. Okay, it does happen. So if you've done that and now you've got a trade that's in your favor, the other thing we tend to do, other than letting our losses run, until our accounts are depleted, the other thing we tend to do is cutting those winners short. So, that bird in the hand is better than two in the bush that we spoke about earlier. So the best way for me is to determine my take profit level before I open the trade. So obviously you're going to say, I think this trade is going up. I'll set my stop loss below the low of the previous candle, for example, very tight. And I expect this to go so many points to a certain key resistance level way up. Let's say it's 100 pips away or whatever. If you determine that before you open the trade, you're not as emotional about those levels when you open the trade as when you're in the trade. Once you're in the trade, your money's, you literally see your money go up and down, up and down, up and down, and you become emotional because you're attaching negative values to losses, and it's not good. It's really not good. So determine it before you actually go into the market, and then let it run. Let the trade run. If it does turn against you, you apply that opposite bias analysis. And if you've proven the opposite bias analysis that you're in a bad position, get out. Cut your losses. If you determine that the price should reach a certain level, ride that wave all the way or not at all. So let's say once price has made a considerable move in your favor, you can apply a break even to your trade. Let's say it's 28 pips or 30 pips up, and your stop level is 4 pips. Why not put in that break even? Why risk taking a loss? Now it could turn against you, hit your break even, turn back and go where you predicted it would go. This happens quite a lot, but that's a break even. That's not a loss. So it takes away the disposition effect altogether. It takes it away completely. You no longer have the disposition effect when you have a break even. So it removes the risk, and it still gives you the potential of a big win or a small win. So it eliminates the disposition effect, and you could potentially see yourself ride that entire wave. Now, there's an opposite to this, and that is you need to keep an eye on fundamental news. Any major news event, geopolitical announcement, stuff like that, breaking news. We used to we went through a period about a year ago when every time Trump tweeted about Korea, price would respond. So you had to literally keep an eye on Donald Trump's Twitter feed to see what he's saying, and price responded to just about everything that related to Korea. This happens when there's talks of tensions for war, because North Korea was playing hardball with missile testing, and basically it was a pissing contest between Trump and President Kim from Korea. But that blew over. Then the trade wars with China started, and we had to watch his tweets as well. So it happens that you need to keep an eye on these things. And if you're in a position and you expect a large run, but news events or geopolitical events could potentially reverse your position, again, get out. Don't risk that. I've done this before, where I've let it run. I didn't even know about the news that came out, and it just completely destroyed my position. I thought about the opposite bias analysis, and said, no, even according to opposite bias analysis, price should still go this way. And so I couldn't disprove my position, but then that kept happening. It kept going against me, and eventually it was a big loss because I just didn't keep an eye on fundamental news and geopolitical events. And if I did, I would have known, close your position immediately. And what was a win turned into a loss because I just didn't keep an eye on that. So that's always important. Always keep an eye on the news, geopolitical events. You could watch Bloomberg Global News Live. They have a show basically 24 hours a day, especially during market opens, an hour before market opens. They have a show both for the London session, the US session, as well as the Asian session, I believe. I don't watch the Asian session because I'm sleeping that time, but I'm told that they have a show that time as well. So you could definitely keep an eye on fundamental news as it progresses. Just put on your TV on Bloomberg or YouTube. They are streaming live on YouTube, so there's no excuse. It's free. It's breaking news and it's free. So definitely keep an eye on that when you're trading anything. It doesn't matter what you're trading. For something that could potentially reverse your position. And, try and keep a level head when making your decisions. Anyway, that is it for me on this topic. It's been quite an interesting one for me. I really enjoyed learning about this and learning how to counter this. So if you found this helped you in any way, please like and subscribe to my channel. I do a daily analysis. It's not always correct, but you can't win them all. And that's one thing we need to learn, is that we have to learn to accept the fact that sometimes we make mistakes. You can't get it right every time. And the reality is, in Forex, whatever position you decide on, there's a 50-50 chance it could go the other way. So if you say it's going to go up, that's a 50% chance that it might, and there's a 50% chance that it might go down. The real difference is, two things: risk management and letting your winners run and cutting your losses short. If you're wrong, you're wrong. Take it on the nose and start recovering from that. You can't get it right every time, and that's okay. It's okay to be wrong. You have a 50% chance of being wrong and a 50% chance of being right. If you get it wrong more times than you get it right, that's okay too. If your risk to reward ratio is that you risk more than, let's say, 1 to 2, risk to reward, or if you want to put it the other way, reward to risk ratio 3 to 1 or 2 to 1. If for every win you get twice as much as you lose for every loss, a 50% win rate is great. You're going to make money. It's not that difficult. It's all about risk management, cutting your losses short, and letting your winners run to your expected levels. That risk-reward ratio. Determine your stop losses and your take profit levels before you open the trade, and let it run to either one. If it runs significantly beyond your opening position in your favor, put in a break even. That takes that loss out even more. Now, if it turns against you, it's not a loss, it's a break even. So you can take that out of the equation. I found that I personally get about 4 break evens, 3 losses, and 3 wins in every 10 trades. So, break evens, take them out of the equation. That's a 3 to 3, that's a 1 to 1 win ratio. That's 50%, exactly like the market gives you. You could potentially get more, potentially get less, but overall I average out like that. And with 50% win rate or loss rate, you just need your losses to be less than your wins or your gains. So just make sure your risk to reward ratio is better than 1 to 1. 2 to 1 should be the minimum, but you could potentially split up your trade. do 2 trades at half the position you would have gone in, and take the one at the first level of profit where you know it's definitely going to hit that, and you expect it might go beyond, but you're not sure. So split your trade up so that when it hits, take profit one, put in the break even on the other trade and leave it open to run for the further one, but take profit at that level. Then you've already got that bird in the hand and the potential for another one in the bush. So why not have the best of both worlds? It's okay to do that. So I hope this helped you guys in some way. The disposition effect is a key concept, and not just the disposition effect, but the research behind it, prospect theory, loss aversion. You need to know about this and apply yourself to actively try and counter it. If you don't, then everything's going to be a loss. You're just going to wreck accounts. You're going to lose every deposit you make. So keep an eye on the disposition effect. Think about it actively on every trade. Cut your losses. Let your gains run. Let your winners run. And try and make some profit from this game we're playing. Forex is fun. It's not easy, but it's not that difficult. It is not rocket science. So, once you've gone through the learning process of technical analysis and all the things you need to keep an eye on, also keep an eye on the disposition effect and your own trading psychology, and try and counter that. Maybe use the methods I've spoken about, maybe look for other options, but this is the way that works for me, and I hope that it helps and that it works for you as well. Anyway, that's it for me for this video. Thank you for your time. I hope it helped. Good luck and enjoy.